Today, we're diving into ADAS analysis, the core model that really helps us understand how a nation's economy functions.
That sounds like a big deal. So what exactly are aggregate demand and aggregate supply? And why is it important to distinguish between A, movement along, and A, shift, in these concepts?
Right. A movement along AD means a change in quantity demanded due to a change in the overall price level, like when lower prices make everyone feel richer. The curve itself doesn't move.
Okay, so a movement is about price changes. What causes an actual shift in aggregate demand, meaning the whole curve moves?
A D shifts when something other than the price level changes individuals' readiness to spend. Think consumer confidence, business investment, government spending, or net exports.
I see. So an AD shift means the whole shopping list of the nation has changed. What then about aggregate supply? What causes movements along or shifts in that curve?
Aggregate supply, AS, is the flip side, representing the total output producers are willing to make. Movement along AS also occurs with price level changes. Producers offer more at higher prices. Shifts indicate a change in production capacity or costs.
Makes sense? So if the cost of producing goods changes, the AFS curve shifts. But what's the big picture then? How does all this interact to establish a stable economic point?
Equilibrium is found where the aggregate demand and aggregate supply curves intersect. This point tells us the economy's overall price level, how much is being produced, and the general level of employment.
Ah, the sweet spot. So these shifts you've mentioned must have significant effects on output, prices, and employment from that equilibrium point, right?
When curves shift, they disrupt this balance, pushing the economy to a new equilibrium. An increase in demand, a D shift right, typically leads to higher output, prices, and employment.
Exactly. Understanding these shifts helps us predict how events impact everything from growth to job levels. A shift in ACLES from, say, a new technology generally means more output at lower prices. Conversely, a negative supply shock, like a sudden rise in oil prices, can reduce output and raise prices. Leave a comment below if you have any questions. Like and follow us for more.